Hello, everybody. My name is Luke Robinson, and I am a business advisor here at Collective. And Collective is a all-in-one sort of back office solution for a small business owner. Essentially, we would handle. Um, sorry, my beard is looking a little unkept here. I apologize to everybody, but essentially, Collective would handle the entirety of your tax situation for your business. And specifically a business that needs to be an S corp. That's what we specialize in. And if you came on board with us, we would have a conversation with you beforehand, go through your financial situation, go through your business situation, and see if an S corp or collective would be right for you. But today, I am running a little session we like to call Tax Tuesday. And essentially, what it is, it's an AMA. It's an Ask Me Anything surrounding taxes. Surrounding best financial practices for your business, or tax strategies or things like that. So please, feel free to pepper me with questions. And keep in mind, though, that consider this just informational content. Don't consider this, official tax advice, official legal advice, or anything like that. It's not. It's just information. And the tax code is extremely complex. Some of this couldn't apply to your situation, or I could be wrong on some of the things that I'm saying. The tax code is updating all the time. But so it's a good idea, before you act on any of this information, go speak to a CPA in your state, go speak to a tax attorney. It's always a good idea to do so. But now that we've got the disclaimer out of the way, let's go ahead and start on some questions. And I believe we already have some coming in. Okay, well, what is an S corp? That's the first question, and it's a good one because Collective is an S corp company, so obviously it's relevant here. And essentially, an S corp is probably not what you think it is. A lot of people think that an S corp is a business entity. They think that it's a corporation, but it's not. It's a tax election. It's a way to ask the government to be taxed a certain way. So specifically, sorry, I'm a little tongue-tied today. Specifically, it's a way to ask the government to tax your business a certain way, meaning that you have to have either an LLC set up, a partnership set up, which is essentially just a multi-member LLC, or you need a C corporation set up, with your state, before you can even elect the S corp tax status. So you got to have a business entity first before you elect the status. But essentially, the big reason why you might want to do that is to save on the self-employment tax. That's the big reason. And before you become an S corp, specifically when you're an LLC, when you're a corporation, you're taxed a little bit differently, but let's just focus on LLCs right now. When you're just an LLC or sole proprietorship, before you get to the S corp stage, a huge chunk of your earnings is subject to the self-employment tax. Self-employment tax, it's a flat tax rate of 15.3%. Before you become an S corp, most of your money, and sometimes all of your money, all of your earnings are subject to the self-employment tax. So let's say that, let's say in 2024, your net income, which is, your total income minus your expenses, let's just assume that's $100,000. Before you became an S corp, how you come up with your self-employment tax is you take $100,000 and you'd multiply it by 15.3%. Every dollar is subject to that full tax rate. What happens with an S corp election? And again, it's an election. So essentially what that means is it's paperwork sent into the federal government. It's sent into the IRS. And what that does is it essentially creates kind of like an employee-employer relationship between you and your own business. Now, this is still your business. You still own it, of course. You're still, established as the owner on the company formation documents. The documents you file with the state to form your company. You're still the owner. But for tax purposes, you also become an employee. And since you're an employee, your business will pay you a salary. It'll pay you a wage, just like you'd receive, if you work for someone else as a W-2 employee. But the cool thing about S corps is that the only chunk of your earnings that's subject to the self-employment tax is your salary. Whatever you pay yourself in salary specifically. So, going back to my earlier example, if someone's making 100,000 and they deem that let's just assume that a $40,000 salary is a reasonable salary for them. In that situation, the first 40 grand would still be subject to the self-employment tax, like the full 15.3%. But the other $60,000, those are considered distributions to yourself. It's not considered salary. And, kind of conceptually speaking, some people think of that chunk of money as dividends, like they'll use that term. But long story short, that chunk of money, the 60 grand is no longer subject to the self-employment tax at all. So, assuming that you make that much money, how you'd come up with your tax savings in this scenario is you would take $60,000 and you'd multiply it by 15.3%, because that's the amount that you're no longer going to be paying in self-employment tax. And, that comes out to $9,180. So in this, situation, it's approaching close to 10% of this hypothetical person's net income. So, once you reach a certain income level, or just a certain situation, it might be beneficial for you to explore the S corp route. Oh, here's another good question. What is the best thing to do for taxes during the off season? Well, there's a couple things you can do. One is to keep up with your bookkeeping, keep up with your accounting, in the sense to where, as you run your business throughout the year, keep your books organized throughout the year. And usually it's a good idea to at least close out your books monthly, meaning that every single month, make sure that all your expenses are categorized into the appropriate expense categories. Make sure that all your expenses are recorded in general, and make sure you close out the books in the sense to where compare your profit and loss statement, which essentially means like your form that shows your income and your expenses, and check it against your actual bank statements. So you go through and you look at what you've been recording for the month, and let's say that you've got $10,000 in income and $4,000 in business expenses. Check that report against your bank statements and go back and see if each income item matches and each expense matches, and close out your books for that month. And that's extremely important to do throughout the year, during the off season. And the reason you want to do that is because so you can accurately calculate and pay your estimated tax deposits, because that's another important thing to make sure that you take care of during the tax off season, is make sure you actually pay your taxes throughout the year. And you can only do that if you have an accurate account of your net income, which is your total income minus your expenses. Because you're only taxed on your net income. You're only taxed on the money that you keep, not the money that you spend. So the only way that you can calculate how much tax you owe each quarter is to have an accurate reading of your net income each quarter. What can Collective do for me now that tax season is over? That's another great question, because here's the thing about S corps is, yes, they have the potential to save you a lot of money. They really do. And in certain situations, I mean, I've seen it save people, $15,000 a year, $20,000 a year. It just kind of depends on your financial situation. But to save that money, there are additional sort of compliance issues that are involved. There are additional complexities that you've got to deal with throughout the year when you have an S corp. And one of the most important aspects is making sure that you run payroll adequately. Because, with this new tax structure, with you being an S corp, you're going on payroll. So you need to pay yourself a consistent paycheck, essentially. And that could be, that's more complicated than it sounds. Because also, too, what the IRS says about the salary and your paycheck is that it has to be reasonable. That's what they say about it. So, and if it's not reasonable, it could open you up to audit. Because this is what people will ask me. They'll say, okay, well, if I'm only subject to the self-employment tax on my salary, then why not just pay myself a super low salary? Why not just pay myself, like $1 in salary or $1,000 in salary, and take all the rest of my earnings out in distributions? And my response is that you'll probably get audited, or it could increase your risk for audit, because the IRS says that the salary has to be reasonable. So to go back to the original question, I'm sorry, I rambled there a little bit. The question was, what can Collective do for me that tax season is over? Essentially, what we'll do is we'll assist in keeping your salary optimized throughout the year and just assisting with payroll in general. Another thing we'll do is keep up with your bookkeeping throughout the year. Kind of how I mentioned earlier, it's a good idea to keep your books closed month to month. Collective will do that for you as well. And also, I mentioned quarterly taxes. That's one of the most important things you can do on the off season. Collective will also calculate your quarterly estimated tax deposits. So essentially, we take care of the throughout the year tax maintenance that is required for an S corp. Here's another excellent question. I know I'm saying that a lot, but you guys have such good questions. How do you stay up to date with everything the IRS does? It's really hard. I mean, obviously this is kind of an obvious answer here, but one of the things you can do is just research on the internet. There's some great sort of, I guess, private companies and private publications and groups of tax professionals and things that post online content and post IRS updates. So it's a good idea to go, look around and, find some reputable sources like that. But also you can go straight to the source. Like, you can go to the IRS website. They post updated regulations. You can read the tax code. You can read the IRM, which is called the Internal Revenue Manual. And it's essentially a manual that is given to all of the IRS general employees that they have to follow in terms of procedure and things like that. So you can technically go straight to the source and read the regulations, as riveting as that sounds. Another question is, can you quickly touch on all the different corporation structures? Of course I can. So, like I mentioned earlier, sometimes your corporate structure or your business structure is different than how the IRS sees you in a tax context. So, for example, you can have an LLC set up, which is just, a basic sort of business structure with your Secretary of State, usually with your state of residence. That's where you set up an LLC. But and when you do that, the IRS automatically considers you what's called a disregarded entity for tax purposes, meaning they still consider you this vague entity that the state sets up as an LLC, but in their eyes, you're not taxed in a special way. You're taxed just like you are as a sole proprietorship. So they call you a disregarded entity. That's what an LLC is. Now, when you set up a corporation, that's different. Now the IRS automatically considers you a corporation for tax purposes. A corporation is not a disregarded entity. So, if you set up a corporation and do nothing else, the IRS will automatically require corporate tax returns for your C corporation, and which, could subject you to double taxation. To taxation at the corporate level and the shareholder level. So, that's essentially how just an automatic corporation works and how the IRS sees it. Another business structure is a partnership. So let's say that in a partnership, essentially a multi-member LLC. It's when two or more people are listed as owners on an LLC. So when you do that, when you automatically have a partnership and you don't do any sort of, S corp election or different tax election, the IRS considers you a partnership for tax purposes, and it requires its own tax return. It's called Form 1065, and it's a partnership tax return. So that's kind of how it works with the different business entities. And kind of going back earlier, you can make an S corp election on any of those entities. You can make an S corp election on a single member LLC. You can make an S corp election on the partnership. You can even make an S corp election on a C corporation. That all reverts to the S corp tax rules. And then you're going to file an S corp tax return if you do any of that. So long story short, it can get really complicated really fast. So if you're not really sure, what structure you should go with, and how the IRS looks at it, or it's a really good idea to get some advice from a tax professional. And with Collective, that's kind of that's why we're here. So if you think that an S corp might be in your best interest, kind of hearing this information, schedule a call with us, and we'll go through your information, go through your business, and even see if an S corp could potentially be a good fit for you. All right. Are there any situations where you don't need to go the S corp route? Yes, there are. There are several situations where where an S corp might not be in your best interest at this time. And one is kind of the obvious one, or it's not necessarily obvious, but it's to where if you're not making enough money, then, or if you're making below a certain income level, then it's very possible that the amount that you'd save with the S corp wouldn't cover the additional administrative fees that are, sort of, I guess, required or are usually associated with an S corp. So there's certain situations to where, you have to pay for payroll. Like usually, you need a payroll processor to handle your payroll. Usually, you got to pay a tax professional to file your S corp tax returns and do all of that, and that costs money. And if the S corp is not saving you above what the sort of compliance requirements are costing, then what's the point in becoming an S corp? You're not saving any money, and you might as well stay, a more straightforward and simple tax structure. And there's other reasons too why you might not want to be an S corp. And one is your type of industry. Specifically, if you're in an industry that is involved, if you essentially make a lot of your money from passive income sources, then you might not be subject to the self-employment tax if most of your income is from passive income sources. Self-employment tax is typically only subject on active work or some sort of active professional situation. So if your income isn't subject to the self-employment tax, there's not a reason to go the S corp, because the S corp is there to save on the self-employment tax. So that's another reason. Why would you want to do that if you're not saving, if there's no self-employment tax to save on anyway? And another reason is the S corp restricts the amount that, or the S corp restricts what you can do with business ownership, in the sense to where if your business entity has an S corp election, it can typically only have up to 100 shareholders or 100 owners in the business. So that doesn't work for some people. That doesn't work for some people who need to fundraise, who need to do things like that. So it might not be in your best interest if you, like, in the future are trying to issue stock to a bunch of people or raise money. You might want to stay as an LLC or some sort of other corporate structure. Can you make an S corp election on a nonprofit? No, I don't think so. I don't know why you'd want to, because I mean the nonprofit is it's nonprofit. Like it typically the self-employment tax isn't really involved in those situations. Now it could be if there's employees in the nonprofit and whatnot, but usually that doesn't have much to do with an S corp situation. So probably not. I can't think of any. I can't think of any reason why you'd want to make an S corp election on a nonprofit, and it might not even be possible. I think the IRS would probably just reject it or say that they don't have a record of a business entity existing. What kind of businesses should think about an S corp election? Well, really, to answer this question, and I know it's pretty broad, but the businesses that are subject to self-employment tax. If you're owner, if you're an owner of a business and the money that you're receiving from that business is subject to the self-employment tax, it's likely that an S corp can save you in that tax. That you might need to be paying yourself out in salary, as opposed to just straight earnings, and that could potentially save you in the self-employment tax. So that's really the best way to answer that question. Is if you know that your earnings are subject to that tax, then you should consider an S corp. You should at least explore it. Here's a question we can all. Here's a question we can all appreciate here. Why do we pay taxes on everything? Well, because the government wants their money. At the end of the day, we are taxed on everything. I mean, we have property taxes to own property. We have income taxes on our income. We have sales tax on things we sell and buy. We have, excise taxes. There's taxes all over the place. And essentially, to answer your question, the reason they put taxes on everything is because they can. And I would agree with you. Like in my personal opinion, I think we're taxed in too many areas. I don't necessarily think that we should be taxed on ownership and things like that. But people have different opinions on that. But I agree. We're taxed on a lot of things, and we could probably ramp it back a little bit. What are the ways to increase your odds of getting audited? Like, what are some reasons that could potentially increase your audit risk, is what this question means. And one is, I think probably a big one, is business vehicle situations. Like people that take the, Section 179 deduction, that, they'll buy, a vehicle through their business and they'll write off a bunch of money and things like that. So that could increase your odds of getting audited. Now, like if you don't have clear documentation and just sort of substantiation as to why to support your position, then you can increase your risk for audit. Now, another thing is paying family members and paying children now as employees. Now, it is technically possible to put your employees on payroll to put your children on payroll and family members on payroll. That is technically possible, but the IRS might look a little bit closer at that. So that's another thing. And another thing is if let's say that you're an S corp and you're paying yourself super low salaries, like a super low salary in your business, that could be another reason why you get audited. So keep that in mind as well. Okay, I think we've got another question coming in. Ooh, okay, here's a good question. As an influencer, can I write off things like getting my nails done, my wardrobe, things of that nature? And unfortunately, you're not supposed to. So if things like getting your nails done and buying wardrobes and things like that, if you're using these things on a personal capacity, which in a majority of the time you are, like you're usually wearing your clothes, elsewhere, and of course, your nails, you're taking those nails once you you're taking those nails with you usually once you stop filming. So the IRS usually consider those purchases personal expenses, even if you use them for businesses in certain scenarios. So no, you're not really supposed to. What kind of changes to the tax code do you see happening in the future? Well, there's been some rumblings of wealth taxes, meaning taxes on things that you own, like stocks, bonds, some sort of properties that you have. There's been some rumblings to tax money that you don't even have. Money that is just tied up in value that you don't even have, that they want a cut of. So that could happen. I don't know if it would. It's kind of, I don't even know. I'm not sure if the courts would allow that, or if that could even get through Congress. I think that'd probably be pretty controversial. But that's something that is being floated, is taxing people on their wealth instead of their income. Why is it a common thing that the wealthy don't pay taxes? What loopholes are they using? Well, it's actually a misconception that the wealthy don't pay taxes. The wealthy pay a tremendous amount of taxes. The wealthy pay most of the taxes. Now, yes, there are ways for them to reduce the tax that they pay, or reduce the, just chunks of their income that is subject to tax. Sure, but overall, just kind of on a society-wide basis, the wealthy pay the most taxes. But here's what they do to shield some of their income from taxes. And for one, they utilize loans against their assets. A lot of people think that the wealthy have just cash sitting around. A lot of them don't. A lot of wealthy people's money is tied up in assets, like buildings, business assets, businesses. Like there's just physical things that a lot of the millions of dollars that people have are tied into. So when they need money, instead of selling those assets, paying the capital gains tax, paying an income tax or whatever, they'll borrow off those assets and pay like a 5% interest rate or something like that. But you're not taxed on money that you extract via loans. So essentially what they'll do is they'll borrow money from their assets, take the money, and they'll use that money on personal expenses. But they don't have to pay tax on that because it's not income. They have to technically pay it back, but the interest rate at which they're paying the bank is lower than what they'd be charged in taxes for that year or whenever. So that's a big loophole that they use, is they'll extract money from things that they own to spend, which is not taxed. Oh, and I believe we're at our time here. This is all the time that I have today, but I actually have to go speak to a prospective collective member. But it was a pleasure. I enjoy it like I do every week, and thank you guys so much for joining. And like I said earlier, if you think that an S corp might be in your best interest, if you think that collective might be valuable for your business, schedule a call with us. Go to our website. It's not a recording. This is a live video, just so you know. But please go to our website, schedule a call. We'll go through your situation, and we'll even see if collective would be a good fit for you, or if an S corp would be a good fit for you. But until next time, I will see you all next week.